started talking about technical indicators. Now, I'd like to qualify something. Tonight, I'm going to use the term security when referring to tradable financial instruments. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, and even cryptocurrency. While I may imply a specific investment product, for example, I may say shares, or I might say Forex, but these investment concepts work with all and any publicly traded financial instruments in the open market. It just gets very, very boring if I just use the word security, security, security. Well, don't think that when I mention shares, I'm only talking about stock, or if I say, assets, it's all financial or tradable assets. Similarly, I also intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. In either case, the basic concepts and the techniques presented are equally adept. So, technical analysis is a field of study, or a field of science, so to speak, for determining what assets I should buy today. What will the prices be tomorrow or next week or next year? Now, wouldn't investing be easy if we knew the answers to these seemingly simple questions? Now, unfortunately, if you're attending this class tonight in the hopes that technical analysis will answer these questions, I'm afraid I have to disappoint you. Nothing can tell you what I should buy today. Nothing can tell you what prices will be tomorrow or next week or next year. However, if you're attending this webinar with the hope that technical analysis will improve your investing or trading, I have a good answer for you. It will. Now, the term technical analysis is a complicated sounding name for a very basic approach to investing. Simply put, technical analysis is the study of prices with charts being the primary tool. The roots of modern day technical analysis stems from Dow theory, developed around the 1900s by Charles Dow. Now, Dow's contribution to modern day technical analysis cannot be understated. His focus on the basics of security price movements gave rise to a completely new method of analyzing the markets. Now, traders who subscribe to technical analysis operate under the fundamental theory that prices move in patterns and that price never lies. Now, I've given you a handout, okay? On your screen, you should see where it says you can download this handout, and it's called Understanding Technical Indicators Guide Handbook. The only way to get this handout is tonight in this class. There's nobody to email tomorrow or call tomorrow or next week to get it. If you want it, don't get it tonight. All you have to do is click on that download button. But if you don't, the next time you'll be able to get it is when I present this class again. So please download it now so that you have it, whether it's on your mobile device, on your tablet, wherever you download. Once you download, you can change it and transfer or save it wherever you want down the road. But please grab it now. Now, to the inexperienced eye, a financial chart may look like an unpredictable line with a lot of jumbles and colors and marks. But these traders are watching charts to pick up on the subtlest of indicators of where price could be headed next. So here's a breakdown of some of the most common indicators technical traders are watching and what they mean. Now, technical analysis involves a lot bigger field or a lot bigger field of study than just technical indicators. Technical indicators, it's just one simple sector. You have price patterns. You have all different types that make up the field of technical analysis. Tonight, we're only talking about indicators. Now, indicators are simply mathematical calculations using a security's open, high, low, and close, and their volume. But the small number of variables has produced hundreds and even thousands of trading indicators. And it's important to understand what all these indicators fit or where they come from, because too many traders have learned some type of gadget, some type of strategy, or their buddy tells them they use RSI and their other buddy tells them they use stochastics and their other buddy tells them they use CCI. So all of a sudden you're using 3 indicators only because your buddies tell you they're great indicators, and they can be great indicators, except they don't work well together, or they give you the same pieces of information, so you're just wasting your time with too many indicators that tell you the same thing. Now, indicators are classified into different groups, and they do different things. So a technical indicator is simply a mathematical calculation that can be applied to an asset's past price patterns, like price, volume, and it uses price and volume, and even sometimes other technical indicators. Technical indicators do not analyze any part of fundamental business. They don't take in account earnings and revenue or headlines. Don't care about them. They don't even worry about geopolitical stress and central bank action. Technical indicators are most extensively used by active traders in the market, as they are primarily designed for analyzing short-term price movements. Now, technical indicators fall mainly into 2 categories. They're leading indicators or lagging indicators. Now, please do not think of one term being positive and one term being negative. Lots of us think the word lagging is a bad thing. Okay? Because when things lag behind, okay, so everybody wants leaders. But that definition of leaders and lagging doesn't really fulfill technical indicators, because a lagging indicator is just as important as a leading indicator. What the difference is a leading indicator are those who lead the price movement. They give us a signal before a new trend or a reversal occurs. Well, that's important to know that something might be occurring, but those leading indicators don't tell you precisely when they'll occur. So you can get something that tells you the market is overbought, but an overbought market can remain overbought for a period of time. And then we have lagging indicators, and those are the ones who follow the price action. They give a signal after the trend or the reversal has started. So if you imagine a rocket, I take a rocket, or I take a firework and shoot it up into the sky. Now, we know, and we can watch, we know that eventually gravity is going to pull it down. So as it loses its momentum, it's going to eventually turn and come back to Earth. Leading indicators tell you that it's losing momentum. Lagging indicators say it's lost the momentum and it's coming back down. Okay. So one is not better than the other. Okay. They are best if used in conjunction with each other. Indicators from both categories belong in one of the following trading types. So now we have leading and lagging, but in those, once we separate by leading and lagging, we have 5 categories in which these indicators can fall. We have trend indicators, we have momentum indicators, volatility indicators, and volume indicators. Now, it's important to understand what category they fall into, more than whether they're leading or lagging, because you don't want to use and spend your time with 3 trend indicators. You should use indicators that are complementary to one another and not duplicates of one another. And there's some indicators that fit in many categories, like MACD will fit into most of these categories. So it means you can use this one indicator to get overbought and oversold conditions, trading or transaction signals, and get divergence. So the first big category are trend indicators. Identifying trends over different time frames are useful because it can help weed out all the noise of daily volatility. Any type of trend, including uptrends, downtrends, and sideways trends, can be traded for a profit so long as it's shown itself to be consistent. Trend traders use a number of different indicators to help them figure out what kind of trend an asset is in. One of the most popular of these indicators is moving averages, which is represented by a single line that represents an average price over a given period of time. Other examples of trend indicators include moving average convergence and divergence, known as MACD, or average directional index, or parabolic SAR, or linear regression. Then we go, so that's only one category. Then we go over to volume. Now, volume is critically important because whether an asset's going up or down, whether it's got the momentum to continue in a direction, okay, is complemented by volume. If there's not volume, means that the price is moving up while the volume of traders or the volume of transaction is declining, means that the traders really don't believe in that movement, or they're starting to leave the markets. So volume, of course, is the measure of the total number of shares that are traded in a given period of time, or contracts. Where volume really comes in handy is for confirmation. Many traders use volume to confirm the conclusion of another type of indicator, such as trend. Sometimes market conditions and the lack of liquidity alone can temporarily drive a stock prices higher or lower. However, these moves are often on relatively low volume and can be short-lived. So in other words, sometimes a piece of news comes out that sends an asset up for a couple minutes, a couple seconds, and it goes right back to where it was. So you see some volume or some volatility happening, but on the whole, the big traders aren't jumping into the marketplace. So on the other hand, if a stock makes a big move on extremely high volume, that's a reliable signal that there's major buying or selling going on, and the move should be taken seriously. And we have all different kinds of volume indicators, like money flow index, Chaikin money flow, on balance volume, demand volume, and force index. Okay, we're going to take a look at these on a chart in a minute, but we're just going to go over the categories first. Then we have momentum indicators. Momentum indicators are like that rocket I told you about, the firework going up. Momentum indicators are like speedometers for traders. They show how fast an asset is moving in a given direction. These indicators are typically displayed as what's called oscillators, which fluctuate above and below a baseline level to indicate how much positive or buying or negative selling momentum an asset is experiencing. Arguably, the most popular of these momentum indicators is Relative Strength Index, or RSI. RSI you'll hear about if you're a beginning trader. If you got buddies that are trading, they're all going to be mentioning RSI to you. It's a well-established indicator and is relatively respected for short-term online trading. Now, other examples include stochastics, which is also very popular, CCI, Chanday's momentum oscillator, and Williams percent R. So now we've talked about trend indicators, telling you the overall direction and how strong that direction is. We've talked about volume indicators, okay, and that's how strong the traders are entering the market. We've talked about momentum indicators, which are the speedometer, and then we're going to talk about volatility. Volatility is a measure of how large a stock's movement is in a given period tends to be. When a stock makes large moves in a short period of time, it's considered volatile. Volatility is a very important indicator for traders because volatility makes it easier to profit due to price inefficiencies. Without volatility, trading opportunities would be limited. Volatility is so important that the Chicago Board of Options Volatility Index, or the VIX, or what we call the fear indicator, is one of the most closely watched indicators in the entire market. Now, in addition to VIX, we have average true range, we have Bollinger Bands, we have envelopes as trading indicators. Knowing how volatile the market is, especially in short-term trading, is very important because you don't want to get stopped out of the market because an asset is trading very volatile. Volatility lets you figure out how big of a range that asset might bump up and down, because you need to understand that you can afford to trade in that market. Because when market's very volatile, you can suffer extremely large profits and extremely large losses. And if you can't cover that volatility based on your risk management, then you shouldn't be trading that asset. So therefore, you should know how volatile the market is. So let's go over to some live charts for a second. And let's take a look at some of these. Now, right now, we're looking at the Euro US dollar. And in this chart, I've added on MACD. MACD is one of my favorite indicators, and it gives us overbought and oversold indicators. It gives us transaction signals, and it gives us trend indicators. And it's simply dropped on the chart below. To use indicators, you just simply locate, no matter what charting service, you find the area that says indicators, and you simply locate the indicator you want and click on the button and drop it on your chart. Almost all the indicators will drop on your charts. Like I just dropped Bollinger Bands. Now, some of them are dropped over top of price action. Others are dropped underneath, but they're always on a chart. Now, Bollinger Bands, we can see the width of the bands tells us how volatile the markets are, but it also gives us a lot of other information. But it's a different type of indicator. Now, all of the modern charts, the computerized Java charts or HTML charts, will drop them on with the standard settings. Okay. Not with some guru's preaching out there. You'll have the ability to adjust them to that guru, but they're usually dropped on the chart based on whoever developed the indicator itself and what the standard is for that indicator. So like for instance, Bollinger Bands uses 2 standard deviation and a 20 period moving average as brown line. So when it's dropped on our charts, it is dropped on with that, with those basic inputs. Okay. Now, most indicators allow you to change them. But if you don't want, first of all, unless you're going to test them and try them out, back test them, you should always use the standard inputs. Okay. You can use many indicators. For instance, we're going to take RSI, which is, like I mentioned before, one of the most popular ones. So we're going to scroll down and we're just going to locate relative strength index. Now, RSI is known as a bounded oscillator because, as I said earlier, all of these indicators are mathematical calculations using open, the high, the low, the close, and volume. Now, the formula for RSI, no matter how it's calculated, when it's calculated, will always come out between 0 and 100. Now, it's said, so when you see this purple band on here, this is what we can consider what we call no man's zone or dead zone, because the indicator only really tells you something when it's above 70 or below 30. Below 30 is telling you the market is oversold, and above 70, the market's telling you, oh, it's overbought. In between is telling you nothing. Okay, so it's considered bounded because it is always between 0 and 100. So it's bounded between those ranges. MACD, on the other hand, uses a 0 line, but can go as high and as low as the calculations happen to be. Where Bollinger Bands is simply 2 bands that are dropped on above and below a moving average using a statistical calculation called standard deviation. Okay. So all of these indicators are slightly different, look different on your charts, and are placed differently. But understanding what they're trying to tell you and what categories they fit in is very important, because a lot of traders, like I said, will hear about RSI, stochastics, and MACD. And what they'll do is, let me just put this, I'm just going to put this other one on the chart for you, stochastics. And if you notice, RSI and stochastics look kind of very much the same. They all give you the same value of information. Now, some traders want to use the 3 and compare them very, very closely. You can see trading systems are so complex that you get lost looking at them. Okay. Like this one here, it's got so many lines on it, you can get lost. But you have to decide what strategy, how you're going to combine your indicators. This is a personal selection. And even though it looks crazy, when they're your lines and you know what the lines are telling you, you know how you set the colors, you can read it. But then the other indicator, which I use quite often, is volume. Volume are the number of contracts or shares traded in a period of time. When you see volume going up or down, okay, or buying and selling, decreasing or increasing, it tells you something about what the markets are doing. Okay, so here we have a very strong downtrend, and we see volume staying pretty steady. That means the traders believe in this downtrend. If we see volume decline, that means they're starting to peter out. But in this case, they believe in this price movement. Here we can see as price shot up, look at these upshots of volume here, that something was causing this volatility. See, each time price spiked up, then it spiked down, it spiked up, spiked down. Okay, so there's some type of interpretation. You can combine these indicators to tell you something about the markets. I just want to take you back to the PowerPoint here. So trend indicators, again, measure the direction and strength of a trend using some form of price averaging to establish a baseline. As price moves above the average, it can be thought as a bullish trend. When price falls below the average, it signals a bearish trend. And as you can see here, three of the most popular moving averages, MACD and parabolic stops. You see, one is a leading indicator, parabolic stops and reverses. I've never used it. I don't know anybody who has used it. Okay. Two of the most popular ones that are used in the market are moving average and MACD, and they're both lagging indicators. So remember, leading and lagging, it's important to understand. Leading give trade signals when the trend is about to start. They try to predict price by using a shorter period in their calculations, thereby leading the price movement. Lagging are those that follow the price action. They give a signal after the trend of reversal has started. Use them to determine a trend. The most common lagging indicator is simply a moving average. Now, these technical indicators measure the direction and strength of a trend by comparing price to established baselines. These indicators are designed to show traders and investors the trend or direction of an asset they are trading. The trend of an asset can be either downwards or upwards or sideways. Trend followers, for example, use trends indicators to analyze the markets. Then under momentum indicators, we have stochastics, CCI, and relative strength index. Now notice, they are all leading indicators. Okay. RSI is a leading indicator, and it measures the stock or the asset's recent trading strength and velocity in change. Now, these technical indicators may identify the speed of a price movement by comparing the current closing price to previous closes. The stochastics oscillator is used to predict price turning points by comparing closing prices to its price range, where relative strength index measures recent trading strength, velocity of change in trend, and the magnitude of the move. So then the momentum is a measure of the speed at which the value of a security is moving in a given period of time. Momentum traders focus on a stock or assets that are moving significantly in one direction on high volume. So as you can see, momentum indicators are especially composed of oscillating indicators that are usually used to determine overbought and oversold positions. Most of them are bounded oscillators, but not all. And then, of course, we mentioned the VIX and volatility. In there, we also have Bollinger Bands and standard deviation. Volatility indicators measure the rate of price movement, regardless of direction. This is generally based on a change in the highest and lowest historical prices. They provide useful information about the range of buying and selling that take place in a given market and help traders determine points where the market may change direction. And if you notice, volatility indicators in most cases are lagging indicators. And then lastly, we have volume. These technical indicators measure the rate of movement regardless of direction. Bollinger Bands measures the highness and the lowness of price relative to previous trades. ATR, average true range, shows the degree of price volatility, and standard deviation uses a measure expected risk to determine the significance of certain price movements. So, volume indicators measure the strength of the trend to confirm a trading direction based on some sort of averaging or smoothing. So you can see we have Chaikin oscillator, we have on balance volume and volume rate change, or you simply have actual volume. Now, the volume of trades is a very important component in trading. It is, for example, used to confirm or infirm a continuation or change in an asset's direction. Many indicators are also based on volume. For example, the money flow index is an oscillator tied to volume that measures the buying and selling pressure using both price and volume. Other volume indicators include ease of movement, Chaikin money flow, on balance volume, demand index, and force index. So when a security is overbought, the implication that buying has pushed the price too far up, and a reaction called a price pullback is expected. When an asset is oversold, the implication is selling has pushed the asset too far. But remember, as I said before, overbought and oversold markets can remain overbought and oversold for a period of time. They're just simply telling you that the price has been pushed up too fast and too high. Now, indicators serve three broad functions: to alert, to confirm, and to predict. An indicator can act as an alert to study price action a little closer. That's all it's doing. It's hitting you in the back of the head and saying, hey, smarty, pay a little attention here. Figure out something might be happening. That's all it's really doing. There's very few indicators that actually give you buy signals, say buy right now, period, the end. They're saying, here's a buy signal or buy alert. Now go do some other analysis and always apply your risk management. Indicators can be used to confirm other technical analysis tools. In other words, if I see a trend line on a chart and I see a trend pattern, a triangle, and I'm waiting for a breakout, my indicators can help me confirm that this is happening. If there's a breakout in the price chart, a corresponding moving average crossover could serve to confirm that breakout. Some investors and traders use indicators to predict the direction of future price moves. Now remember, indicators indicate. This may sound straightforward, but sometimes traders ignore the price action of an asset and start focusing solely on an indicator. Indicators are basically filters of price action with formulas. As such, they are derivatives and not direct reflection of price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. Always, regardless of what the indicator is telling you, whatever is happening on the price chart supersedes that indicator. What is the indicator saying about the price action of security? Is the price action getting stronger or weaker? Even though it may be obvious when indicators generate buy and sell signals, the signals should be taken in context with other technical analysis tools. An indicator may flash a buy signal, but if the chart pattern shows a descending triangle with a series of declining peaks, it could be very easily a false signal. As always, in technical analysis, learning how to read indicators is more of an art than a science. The same indicator may exhibit different behavioral patterns when applied to different assets. Indicators that may work well for IBM might not work well for Delta Airlines or Google. So you shouldn't just be randomly picking assets and then randomly dropping indicators on there. You might find that stochastic works extremely well for euro crosses, or maybe just for gold, where oil works better with CCI or oil works better with RSI. And you have to see. Now, for instance, we talked about RSI being above 70 and below 30. You might find assets that range holds, but it might be better at 75 and 25, or that the market overall for that particular asset or asset range could have different nuances for the current market. So through careful study and analysis, expertise with various indicators will develop over time. As this expertise develops, certain nuances as well as favorite setups will become clear. There are literally hundreds of indicators in use today, with new indicators being created every week. With new computerized trading and all this data being able to be crunched by computers, all these so-called gurus are coming up with their own indicators or modifications of other indicators, or do this or do that. And unfortunately, it offers all of us too many choices. Okay. I've used MACD for my entire life and I've never varied it. Okay. Now, when I use Bollinger Bands, I use a 2.5 standard deviation as opposed to a 2, but I've been using that for 20 years. Today, you can use a 2.1, a 2.2, a 2.5. All of this has nothing to do with what John Bollinger intended it to do. But some guru out there is telling you to do this or do that. So keep in perspective. Now, given the amount of hype that is associated with indicators, choosing an indicator to follow can be a daunting task. Even with the introduction of hundreds of new indicators, only a select few really offer a different perspective and are worthy of attention. If you notice tonight in class, and even the hand, we really only talk about a certain group of range of indicators, because you know why? They've been around for 20 and 30 and 40 years. They've been tested in the market. They've been back tested, and we know they work. And they work for all of us. Okay, they're not somebody's modification. There's not somebody's thing that used today that works right now in the market for the last 2 years, but that's all that has worked in. Okay. Strangely enough, the indicators that usually merit the most attention are those that have been around the longest time and have stood the test of time. When choosing an indicator to use for analysis, choose carefully and moderately. Attempts to cover more than 5 indicators are usually futile. It's best to focus on 2 or 3 indicators and learn their intricacies inside and out. Try to choose indicators that complement each other instead of those that move in unison and generate the same signals. For example, it would be redundant to use 2 indicators that are very good for showing overbought and oversold levels, such as stochastics and RSI. But do you know how many traders I know that use both? And they also have now today, they have an indicator called stochastics RSI, and they use all 3. Well, you can overcomplicate your trading trying to find the perfect way to trade and never get a trade in. Getting too many indicators, find the one that works for you best. Find the one that you learn and know inside and out and stick to it. You don't have to spend forever. But understand the difference between leading and lagging is very, very important. As their name implies, leading indicators are designed to lead price movement. Most represent a form of price momentum over a fixed look-back period. And lagging, as their name implies, lagging indicators follow the price action and are commonly referred to as trend-following indicators. Rarely, if ever, will these indicators lead the price of an asset. Trend-following indicators work best when markets and securities are developing strong trends. They are designed to get traders in and keep them in as long as the trend is intact. So for technical indicators, there is a trade-off between sensitivity and consistency. In an ideal world, we want an indicator that is sensitive to price movement, gives early signals, and has few false signals. Forget it, it's not going to happen. If we increase the sensitivity by reducing the number of periods, an indicator will provide early signals, but the number of false signals will increase. If we decrease the sensitivity by increasing the number of periods, then the number of false signals will decrease. But the signals will lag, and this will skew the reward to risk ratio. So, don't you think the gentlemen, the analysts who developed these indicators, tested them in every way, shape, or form? So, in most cases, leave the standard settings. So there's lots of different choices out there. I've tried to give them all to you, or a lot of them, in your handout. Okay. But remember, you have overbought and oversold signals, you have transaction signals, which are buy and sell signals, or you have divergence signals, you have trend signals. And finally, you have oscillators. And oscillators are what they, RSI, they oscillate between ranges. And they help us give support and resistance identification, trend identification, other technical analysis tools. By being aware of the broader picture, oscillator signals can be put into context. It's important to identify the current trend and even ascertain if a security is trending at all. Oscillator readings and signals can have different meanings in different circumstances. By using other analysis techniques in conjunction with oscillator reading, the chances of success can be greatly enhanced. So, and remember this, technical indicators should be your secondary feature. They shouldn't be your primary feature in determining a trade. They should be what you use to support other information or other reasons you might want to trade. Whether an asset's trending up or trending down, using trend lines, support and resistance line, using price action on charts, using fundamentals. Okay. Your indicators can then verify these for you, but they shouldn't be your primary look, because you should be looking at price action and price on charts before you look for anything else. So on that note, I'll say goodnight to you. Please use the handout that I gave you, and hopefully adding indicators into your current trading scenario will work great. In a few days, we're going to have a class on chart patterns, and using chart patterns along with indicators as indicators to support your chart patterns gives you a great trading plan. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and have a great trading week.